Yes, yes, yes. Thank you.
Yes, now we see.
On this computer, on this computer. So today we have a lecture, and I would like to begin from a short excursion into finance because it's very important. The financial terms are very essential for our course, and today we discuss key object and products. So let us think about it in terms of some examples. Imagine that you're a young worker with high salary. What should you do? If you have access to financial markets, you have possibility to deposit or invest in stock and bonds, to financial retirement, home ownership, education. In other words, you have possibility to remove our money from present moment to future moment, from a moment where you have a lot of money. It is it can be described as as state of nature to another state of nature where we maybe haven't a lot of money. But if you haven't financial market consumption, only consumption, what else? And the second example, you are a farmer producing oranges. What should you do? If financial markets exist, if you have access to financial market, you can to hedge using future markets, weather related derivatives that pay when there is an unseasonable growth. Because you know that maybe you remember that in Florida was unseasonable frost which killed all harvest of oranges. But if you have access to financial market, you can to buy weather-related derivatives and hedge yourself. But if financial markets, but if financial markets don't exist, only the spot market available, and we are only in mercy nature. So maybe you see, you understand why we need financial market. Financial market exists because they provide enable efficient allocation of resources across time and across states of nature. So we should distinguish the main terms of finance, then describes and explain the main concepts. Each individual, corporation, intermediaries, and financial markets. You see, what is individuals? Maybe it's clear. It is me and you, and we together. We buy food every day and earn money, and so our financial activities can be described as dilemma, consumption and consumption or deposit. You have spent today, or you have a deposit and have more money, but not today, in future. What is corporations? Corporation, it's different companies, firms, farms, which manufacturing factories manage business, and they have possibility to issue stocks for involving money for their funds, and it's very important. And what is intermediaries? It is the company, their financial activities can be described as money, make money. What do you think? For example, what is intermediaries?
For example, banks.
I don't hear.
Banks.
It is, yes, it is different banks, pension funds, and other different funds. So you see that financial markets and financial markets you see on this picture. Financial markets include money from individuals, from corporations, from intermediaries, yes, and financial instruments, not only money, but financial instruments, including securities. What is securities? It is paper about financial obligations. And you should distinguish underlying and derivative financial instruments. Really, financial instruments can be underlying or primary and derivative or secondary. What is underlying? Underlying, it is bank account, so you can open an account and deposit your money. Bonds, for us, it is the same as bond accounts. And stock. About stock, I will tell you later today, but later. And derivative, derivative, it's forwards, futures, swaps, and options, and detail will be later. So today I'm going to consider 3 possibilities for you. So it's lesson about 3 possibilities for you, and you can make your choice. 3 possibilities. The first possibility, to deposit in bank account if you have money. For example, imagine that you have money, but not a lot of money, but some amount, and you have deposited this money in bank account. Or the second possibility, you can borrow from bank and buy risky assets. For example, stocks of Google companies. Stocks of Google company isn't very cheap, and maybe you haven't enough money to buy this stock. But if you borrow from bank, you have this possibility. And the second possibility, to use derivative. So today I would like to tell you about these 3 possibilities. The first possibility, and what should you know about this possibility? What mathematics is involved, and it's necessary for using this possibility. If you are going to deposit in bank, you should know about simple and compound interest rate. So it's first. If you have an amount A, and for example 1,000 of hryvnia, and you are going to invest for n periods, for example it's 3 years at a simple interest rate. So the formula for amount at the end of period will be A multiplied 1 plus n r times n. Yes, it is amount at maturity. Do you understand this formula? It's clear for you?
Yes.
Yes, but if we talk about compound interest rate, the formula will be different. This amount of A we multiply to 1 plus R, where R interest rate, for example, 5%, and to the power of n. If we have 3 years, so in the power of 3. No, I think that you know this formula, yes?
Yes.
Yes. But we can consider periodic compounding. If we have, for example, m periods in 1 year, so the formula will be in look at this. A multiplied 1 plus R divided by M, where M is number of periods, to the power N multiplied M. And more detail, we consider this formula on practical class. And it's interesting if we have limit and N trend to continue. So maybe you remember that it will be exponent, yes? So we have the formula for continuous interest rate. For continuous interest rate, it will be A multiplied year to the power N multiplied R. Maybe if you do all home exercise, you remember it better. And it's interesting that this formula we can obtain from this differential equation. In the left side, you see the speed of amount A, of changing of amount A, yes, d8 respect to dt. And at the right side, you see the product in A and amount AT, so it's proportional, this rate and proportional amount. So you can say that this speed proportional interest rate and amount A at the time t. And how to solve this equation? I think you know. This what can you say me? What is this differential equation? What's your order? What's your name? Do you know? And how we can solve it? Okay, Sophia, would you like to explain?
Okay, so it's a differential equation of the first order, I think.
Yes, first.
Yeah, okay.
First
So,
order. And what is type? What is type? Simple type. Very simple.
maybe separate.
Yes. Maybe with separable sides.
Yeah.
Maybe separable terms. I don't know exactly. Yes. So the first step for solving it is Sophia.
Just to move A with index T to the left, right, to the left side.
Yes. And how we can do it?
Just divide by.
Yes. So yeah, exactly. Thank you. Well done. So we divide both sides by a sub t. and multiplied by dt, both sides, and after that integrate. And we obtain this formula. So if we have a very simple case that that you own $20 in your pocket, and you have decided to deposit in terms 1 year. What's your profit? Please compute. What's your profit? $1, yes, because the amount at the end of period will be $21, yes. I don't know, but I advise that that you take a paper and write down, because today we have 3 possibilities. So please take a paper and write down the first possibility. I should write this on the blackboard, but if we haven't blackboard, please write it in your paper by yourself. So 20 multiplied to 1.05, and this equals $21, and profit 21 minus 20, it is $1. If we analyze this choice, this possibility, what can you say? That is it risky? No, it's we haven't risky for this operation, but we can't scale this operation. So we have profit of $1, and that's all. We haven't to borrow in bank for our business about the deposit, because if we borrow, we can repay. So this, in summary, we can say that this possibility riskless, but the profit is very small. And before we can consider the next possibility, I would like to tell you about stocks. What is stock? Stock is security. Do you know how we can translate security? Security. I don't hear. What is security? I don't hear, because so I say it is a цінний папір. Stock or shares, it's action. Stock is security, what represent value ownership. They can be converted into cash. Maybe, I don't remember, in American financial community, we call this shares.
Actually, those are just synonyms. Shares.
Mm-hmm.
Yeah.
You can see on this picture stock certificate, but now all this operation, all these activities is online. So now it's changed. And what is different, what is interesting, that in 1900, Louis Bachelier, it is a French scientist, mathematician, was the first who considered the motion of change stocks as a stochastic process, and he And he wrote, no, as a Mandelbrot, a stock exchange is a black box or a live organism that input information and output behavior according to rules to be deduced. So to know these rules is very important, and a lot of scientists, a lot of company wanted and want and now want to guess these rules. And Louis Bachelier, Kendall wrote that the demon of change drew a random number and added to current price to determine the next price. It is all for summary. Market price of stock is very fluctuated. Because at any given time, the price of stocks is a balance between supply and demand, and it's changed every moment. And now we have we consider then second possibility. So please take your paper and write about this second possibility. You again own $20 and have you in your pocket, and you have decided to buy stocks, for example, Google company, and for example, the price for today $600, but now it is more expensive. I don't know exactly. You can see, but if I'm not mistaken, it's 1,300 nearly, approximately. So you need to borrow from bank $580. Yes. In 1 year, for example, it's our model. The price can go up to 650 or go down to 550. What is your profit loss in both scenario? If we have the up scenario, so the price will be 650. Yes, 650.
Yes.
But we should subtract from this sum. What can we repay? But we can repay 580 multiplied by 1.05. What is this sum?
609.
Yes. So we have in as a result only
$41 minus $20, and this is $21 as net profit.
Yes, and $21 is a net profit.
Yep.
It's very good. It's more than 100%. Yes.
Yes, according to our how to say it, our principal, which is $20.
Yes, but if we have the up scenario, so we should subtract from 550 609, and it will be negative result. Yes.
Yes, minus $59.
Yes, and it's trouble. But if you have decided to buy not one this asset stock Google, but 2, 3, or 10, and it will be a very big loss.
Yep.
You understand? So what we can say in summary, that this choice, this possibility is very risky. Yes, but if you want, you can scale, no, scale that, understand масштаб, да, you can you can scale this profit. You can borrow as much as you want, and you can get profit as much as you want, but maybe the situation when we have a loss as much as it can, and because market price of stock is very fluctuated. But we have question too: how can we reduce the risk? Because it's very good possibility for us, but risk, how we can reduce risk. And for reducing the risk, there are derivatives. Maybe you don't know about it, so this lesson for you. What is derivatives, it is contracts or agreements between two parties, a buyer and a seller, and price of derivatives depend on underlying assets, depend on derivative on. You understand why this is securities called derivatives? Because your price derivative from underlying assets, stocks, shares, oils, gold. So it's only contract. Um, it is the same. A financial instrument whose price is depends on or derived from underlying asset is called derivatives. Today, after this lesson, you should full crossword, guess crossword, and this will be derivatives. This word will be in crossword. Which types of crosswords? Forward, futures, options, and swaps. It is the main types. But and we begin from forward contract. A forward contract gives the buyer the right and also the obligation to purchase a specific amount of commodity at a fixed time at a fixed price. You understand? Yes, not for example, delivery of a stock with maturity 6 months. So in this forward contract, we point amount, we point time, and we point price. For example, today gold cost some $100, but we fixed price as $100 and 10, and we but the time 1 year, and we hope that the price will be more than 110, maybe 150, and we win. Understand what's our hope? We can see that this under this graphs. After there, I would like to tell you about short position and long position. Long position, it's position of the buyer, and short position, it's position seller. And on the first graph, you can see a long position. It is one axis, it is stock prices, and the y-axis it's payoff, profit. And it is this formula S minus K, where the S it is this X, if we usually write x, it will be y equals x minus k. So as for mathematician, it's clear. This is x and minus k. It is moved on k units below. Is it clear? This graph? No? Can I explain again about this?
It's clear.
It's clear. Yes. Before car, it's your loss. It's your loss. For example, if car will be $100, so before car it's loss, but after car it's a win. But for short position, it's opposite. It's clear. So go on. Swaps. Maybe swaps we miss a few words. Swaps are contracts that transform one kind of cash flow into another. And if you want, you can read about this in the book How Options, Forward, and Another Derivatives. I downloaded this book on this today. And now about futures. Forward and futures, it's very similar. It's very similar, but there are a difference, but not very essential. Forward, it's private contract between two parties, but futures, it's exchange trade. The forward, it's not non-standard contract, but futures opposite. Usually in forward, usually one specified delivery date, but futures range of delivery dates. Forward settles at end of contract, but futures daily. So forward has some credit risk because it's private contract, but futures no credit risk. But all mathematics are the same, forward and future. What is more interested for us, it is the option contract. The option contract. What is this? For example, stock options. Stock option is a contract between a buyer and a seller, and the buyer of the option has the right to buy or sell underlying stock at fixed price on or before the expiration date. And what is interesting and what is very, very, very important, that the buyer of the option isn't obligated to pay or sell the underlying stock. The buyer will only do this when it's profitable. Understand? What can you say about this? Very useful contract, very convenient, yes. But what can you say? There are any mind about it? No. Sometimes students can say at this slide something. You know. Then the next possibility. The next possibility. Again, you own $20 and you have this sum in your pocket. You have decided to use to use stock call option, we strike price 610 and time to maturity 1 year. And we have model about stock as in previous example. So what will be in previous example that we have today the price is $600, but there are two scenarios, and price can go up to 650 and go down to 550. And I advise you to take paper and to write down again this third possibility. Mhm. So let us consider the up scenario. The up scenario. The up scenario. The stock price is 650. You remember? Yes. Yes. No.
Yes, yes.
Yes.
Yes. 650. And we have this agreement and option is agreement, yes. And in this agreement, pointed the price 610, pointed price 610. So if at the time of maturity price more than this, the difference, it's our win. Understand?
Yep.
Yes. So our profit is 650 minus 610. It's 40. It's $40. It is not profit. It called payoff. Payoff. Remember, please. It called payoff. Payoff. So payoff $40 and minus our $20, and we have net profit $20. Yes, for your function 40, but net profit $20.
And what about those money that we owe to the bank? Don't we have to
Interesting question. We don't need money for the bank. We don't. We have only agreement. We have only agreement, and in this agreement we have price 610, and we can consider this in two variants. First variant, this it is price, and we can buy stocks on this price. Yes, we haven't money 610, we have only 20, but we say we buy your stock for 610, but we sell at this moment immediately.
I got that.
Да.
And what is the premium? The premium is these $10.
And what is
Premium.
yes, and I wait this question. I wait this question because it will be very nice, and if this contract will be free. This contract isn't free. This
Yes.
contract is free, and the cost of this agreement is called premium. Really. So it is question 2. I tell about it, but before this, say me please what will be at the down scenario. The down scenario when the price will be 550.
We will actually pay our premium and we just won't do any actions. The contract will expire and that's it.
Yes, thank you. Why? Because the option, it's not obligation. It's not, it's only right, but not obligation, this agreement, yes? So
Yes.
if we not win, we can throw this agreement to the trash as lottery ticket when don't when what didn't win. Yes. So uh, and uh, about premium, about amount of premium. It is the main questions of financial mathematics. Is premium fair price? For example, that $10 or $20. Yeah. It's very important questions, and we can work, we can consider this question on next lessons. So, what is elements of stock options? It is the price of the option, known as the premium. It is the predetermined price, known as the strike price. Remember these terms: premium, strike price, or exercise price, and it will be letter K. And the stock's price, it is S from T, and the expiration date, it is T capital. So you should remember this. Premium, it will be C little or P little, because the call or put option. It will be exercise strike price K, it will be stock price S from T, and the expiration date T capital. And a few words about type of options. There are two types of option: put option and call option. If shortly, put option, it is right to sell, and call option, it's right to buy. A call option allows the buyer of the contract to buy the underlying stock at the strike price, and the buyer will exercise the call option only when the stock price more than exercise price. So uh, more the he buy this call option only if we hope that the stock price will be more than exercise price. And put option is opposite. The buyer exercises the put option only when the stock price less than exercise price. And this graph, you remember how this graph looked for the forward contract, and what is difference between option contract. You see that this line, this line, not at the previous graph, but it is as horizontal. Yes, from this K. K, it is strike price. So it can be right mathematically, S minus K with plus minus P. What is mean this plus? It means that it will be S minus K when S more than K, and K minus S when S less than K. No, so it is this similar at the forward contract. This S minus K, yes, it's profit. S minus K as a forward contract, and this is for your function. This is for your function, but minus P, it is net profit. But S minus K only when S more than K. But if S lesser than K, it is only zero, because the owner of option can don't have obligation to realize this. Do you understand this graph? If I should explain again, say me please.
Actually, it's clear.
It's clear, yes?
Yes.
Thank you. But it is as more than k, but in these graphs, it's you see the short position, seller position, or short position, and you should consider this more detail. And if we hope that S will be in future less than k, no xk, it's mistake. S more than k, and in this S less than k. It's my fault. That will be graph which looks as this. No, you can this read more detail. And there are another and all that I explained to you, it will be about European option, but there are American option, and what is difference? An American option can be exercised not only on, but and before the expiration date. So if you own American option, you have choice, and you should to make decision what is date when you should realize your option. Understand? But European option can only be exercised on the expiration date. If expiration date is, for example, the 1st of December, European option can be realized only the 1st of the 1st December. But American option on the any date for the 1st of December. And every day, if you own the American option, you can think, oh, can I realize today this option? Oh, I should wait. So the buyer of the option has the right but not the obligation to exercise the option. A call option would be exercised when the stock price is above more the strike price. A put option would be exercised when the stock price is below the strike price. And a fair price of the option is defined using arbitrage method. Not on the arbitrage method, but for example, arbitrage method, because this is word is important for you to remember. So summary about our today lesson. Financial markets exist because they provide efficient allocation of resources across time and states of nature. No, and yeah, because they hedge the owner. Second, non-risky primary financial instruments. It is bank account and bonds. Their price depends only on time, not on random, only on time. And you should know about simple, compound, and continuously interest rate after today's lessons. Risky primary financial instruments. It is stocks or shares, it's the same. But there are another, but we focus on the stocks. Market price of stock is very fluctuated and can be described by stochastic process. Derivative financial instrument. It is forward futures options are used to raise capital and reduce risk. A fair price of the option is one of the main problems of the financial mathematics. It is essential. And reference, it is two books, John Hull, Option Futures and Other Derivatives. And today you can read chapter 1 introduction, these pages and about option, it is chapter 8. And Shiraya, essential of stochastic finance. The both the books I downloaded on the DigitalDo, so welcome and use. And that's all. Thank you for your attention. And thank you for your attention. And now we have time, and this and this time I ask you to fill crossword. It is a task, and you should download this on DigitalDo. So let's begin. Understand? Is it clear? Sophia?
Yeah, okay.
Yes? And we meet at 11 o'clock, or and 11:40.
Mm-hmm. Yeah.
So, so till our meeting. See you soon.